All right. Welcome everybody. This is going to be the first video out of the series of teachings I plan to give to you all. This will be an introductory video, basically talking about the foundation of the system, what it is to look for, what to not focus on, and kind of get you guys in the right headspace on what it is that you should be looking at in these charts. All right. So without further ado, let's get right into it. So something that's very important to note is, as a trader, we all make money off of trend. If you don't have a trend, you cannot make money, right? So the importance is that we are always trying to catch a trend, right? Now, if we kind of break that down into as basic as we can, all right, we need movement. We need one directional movement for us to make money. If we go to look at how candles print, so a bearish candle, open, high, low, close, and a bullish candle, open, low, high, close, okay? Every high time frame candle and every candle in general prints like this, all right? All bearish candles open, create a wick, expand lower, and close, and then vice versa, all right? Now, if we are looking to trade the expansion, because again, expansions is where the money is made. That's how we as traders make money. Then it's likely to say, okay, well, we want to catch this and this, all right? These are the expansions in these candles that we want to be catching, right? Whether you're an intraday trader, a swing trader, a short-term trader, okay? We want to be catching this. Now, what does this mean? Right? Well, if these are high time frame candles, that means this is the open, this is the wick, this is the expansion, and this is the opposing wick. Okay? So what this means is we want to catch entries at the wick of the candle we're trading or after the wick of the candle we're trading, because that's when it's going to be one-sided directional movement. Right? The same with for a bullish candle. We want to trade at the wick, whether this wick and this high time frame candle is a daily candle for low a day, whether it's a weekly candle for low a week, a monthly candle for low a month. Okay, we want to trade at the wick of this candle and after the wick of this candle, because that's when the expansion is going to occur. And that's how we can position ourselves to either catch the low and ride the expansion, or catch an entry inside of the expansion and ride it, all right? Now, because price is fractal, we can do this in a few different ways, all right? My personal favorite is the weekly candle, okay? So if we go to an hourly chart, most people see this hourly structure here, and they just see hourly up and down, right? They just see these candles. What I see and how I view it is all of this price action is embedded into a singular high time frame candle. Kind of think of this as the anatomy of a higher time frame candle, right? So this is the start of the week and the close of the week, right? So all of this hourly price action here makes up of a singular higher time frame weekly open, low, high, close, right? This entire hourly structure makes up a singular candle. The same way that if we go to a 4-hour chart and we mark the start of May and the end of May, all of this 4-hour chart, or excuse me, all this 4-hour price action here makes up a singular monthly candle here. Okay, so it's important to note this because when we're looking to trade the trend, when we're looking to position ourselves to catch expansion, we want to do so at the wick of the candle we're trading or after the wick, right? The same way as if you were trading a daily candle for say. You know, maybe let's go to a random day. Let's go over here. Let's do this. If you were trading a daily candle and you mark out 1700, which is the open, to the close, okay, the best trades and the best expansions you're going to find are going to be at the wick of the candle or after the wick of the candle, right? Notice the consolidation and choppiness beforehand versus turtle soup, expansion, retracement, expansion, and then we close, okay? So part of this thought process is, again, we want to be catching the trend. The trend forms after the wick. Therefore, with just that idea in mind, we always want to trade, regardless if you're an intraday trader, a scalper, a weekly range trader, monthly range trader. You want to trade at the wick of the candle or after the wick of the candle, because that's when you can position yourselves and you can hold longer term and catch the actual expansion. Okay? So now let's get into this a little bit deeper. So my personal favorite candle to trade is the weekly. All right. Reason being is it provides a good map out of what days of the week are likely to be the highest probability. Okay. And let me show you an example of that. If we just go to this week, for example, we mark the weekly open and we mark the weekly close. Okay. So I was bearish on this week. From this weekly gap, again, if we look here, this is a weekly gap. I was bearish on this week, okay? Now, if I'm bearish on a week, that means that I want to be trading at the wick or after the wick to catch the expansion, right? So in order to do so, I want to wait, and this is another thing that you want to think about. So when we're trying to anticipate wicks of high time frame candles, wicks of high time frame candles almost always form inside of high time frame levels, right? This is a good way to view accumulation, manipulation, distribution, all right, is based off of when do we actually tap high time frame levels for the manipulation to continue, all right? So that's how I base my process of understanding where do wicks form and when can expansion begin to occur, all right? So in this example, we had SMT on dollar at the high or inside the gap. We had an internal soup, an expansion, and then we had SMT at the low, all right? But for this weekly candle, again, because price is fractal, I can break this weekly candle down into daily candles. Monday, Tuesday, and so on. Okay. Now, if we look at it like this, which days of the week were the highest probability in here to catch this directional move? It would have been Wednesday and Tuesday or Thursday, right? And notice, for everyone who traded Monday and Tuesday, it was very consolidative. Why? Because the manipulation hasn't been put in yet, right? Again, we want to trade at the wick and after the wick because that's when we get the true expansion. That's when we can take entries and we can hold versus taking entries and getting stopped or getting trapped in consolidation, right? That's what we want to avoid, okay? So understanding where the wick of the high time frame candle is likely to form, and then validating which days of the week are likely to give you the best expansions based off of that. Again, if I do this, if I mark a weekly candle, right? So let's say, for example, this is a weekly candle, open, close. If I'm expecting a bearish candle to print something like this, okay? If this is Monday, Tuesday, Wednesday, and then Thursday, Friday, okay? It would be likely that you should avoid trading Monday. Why? Because the wick of the week hasn't been put in yet. Then you seek to find entries where you expect the manipulation of the week to occur, which would be in the wick at the high time frame level. Or you catch continuations inside this Tuesday, inside this Wednesday, until we meet the opposing end of the range where the other wick is likely to form, in which again we would likely see consolidation. all right? This entire thought process is all about validating which days of the week are likely to be the best days of the week to trade. All based off of simply how candles print, right? All bearish candles print like this. They all print with likely a range. They open high, they create a wick and some sort of level. They expand, they create an opposing wick, and then they range again, okay? Understanding the anatomy of this on an hourly chart and then fractalizing that hourly chart into days of the week, understanding which days are likely to form the high or low, what days are likely to give entries that are sustained expansions, not short term, okay? That's how you can successfully catch trends and consistently catch them, right? And avoid ranges. That's one of the key things. A lot of people think trading is all about catching good moves, okay? Trading is about avoiding bad moves and growing capital, all right? Anyone can catch a good trend, but can you stay out of the ranges before that trend forms? Or can you stay out of the ranges after the trend forms, all right? That's the important part, and that's why understanding what days of the week are likely to provide that expansion is so important, okay? Now, that will kind of sum up this initial video, just for the introductory. And again, just to summarize everything before I close off here, it's understanding that you always want to trade in the wick or after the wick of the candle that you're trading. Again, whether it's a weekly, whether it's a daily, whether even if you're a scalper, an hourly, okay? That will give you the more sustained expansion than trying to trade the range at the beginning of a candle, okay? And within that, how I personally do it within my own model, because I specialize in a weekly candle, all right? I'm looking for where is this week likely to print its wick, AKA its manipulation, and then I validate days of the week to trade based off of that idea, right? So if I have a high time frame level, I'm expecting a bearish candle to hit, and that bearish candle hits it on a Tuesday. That tells me that Tuesday, Wednesday, and then possibly Thursday, depending on when we hit opposing liquidity or targets, right? That tells me that Tuesday, Wednesday, possibly Thursday are likely to give high quality entries because we're going to be in the expansion phase of that weekly candle if my bias and my key level is correct, all right? Now, I will get into further on how to pick the correct key level, all right? But this, again, just an introductory video. So I hope this was insightful, and I will see you guys in the next one.